just silver catching up to a reality. But by the way, we've run studies in MSA for our subscribers that show some prior examples. And these aren't normal, I'll admit that. But when a market has made a mistake and stayed confined too long, and I'm talking about being depressed now, copper went through such a situation. If you go back and look at long-term copper charts back in 1970, 1980 to 1990 into about late 2005. So multi-decade range, copper was in a range from roughly 50 cents to $1.50. Back and forth and back and forth. That was its old reality. In late 2005, it broke out of that price reality. In a matter of a couple quarters, quadrupled in price, up to $4.50 an ounce, per pound. And lived in a new range after that. Oh yeah, it had some sell-offs after that explosion, but literally in the several quarters, it quadrupled. It didn't incrementally go up to a new reality, it exploded. Gold miners are at a point now when you go back in the 1980s, 70s, and 80s. See, XAU index is a good metric for that. It's gold and silver miners, XAU index, Philadelphia gold, silver index it's called, but it's actually miners. In the 1980s, 1990s, 2000, up till 2008, that index, if you divided it into the price of an ounce of gold, was in a range above and below 25% of the price of an ounce of gold. Divide XAU index into the ounce of gold. It had lows at around 17, 18% of the price of gold and highs 35%. So let's call it 25% is the median of that multi-decade range of relative valuation. In the 2008 through 2015 decline in the miners and relative performance, much of that in 2013, 14, and 15, as there was a bear market in gold and the miners then, the relative value of the miners dropped to 4% of the price, XAU, the price of an ounce of gold. So you had something that lived in the median 25% level and went to 4%. And since then, since 2015, it's lived in a range, relative performance, of highs just above 8% and lows around 5% with that extreme low at 4%. So very cheap range relative to its historic ratio to gold. It's pushing at the upper end of that range right now, where XAU index divided into an ounce of gold is now pressing toward the upper end of that basing pattern. If we see XAU index get up to about 8.6+% divided into an ounce of gold, right now it's 8.12, I think 8.17, I think the last I checked. You clear the top of that range on that decade-wide basing pattern of relative performance valuation. You could gush that relative performance, you could double it just to bump the underneath side of that prior multi-decade range.
The current setup signals a possible regime shift. After nearly a decade confined to a tight valuation range, mining stocks are now pressing up against levels that have historically preceded major breakouts. If this relative ceiling gives way, the upside won't be gradual, it will be explosive. Past cycles show that once miners break free from extended undervaluation, they often outperform gold itself, sometimes by a wide margin. This isn't simply about miners moving in step with gold. It marks a phase where operational leverage, a sharp reversal in sentiment, and renewed capital inflows converge. At this point in the gold bull market, miners aren't expensive. They're tightly coiled, deeply compressed, and increasingly positioned for rapid acceleration.
In other words, when we break out on the XAU versus gold relative performance, not only will gold miners perform as well, but better than what gold is doing at that point. And they look ripe for that breakout. So in other words, at this phase in the gold bull market, while the miners have been firming from that 5% level now up to 8%, it's still very cheap. And if they break out of that range, you could see a gush in terms of relative performance. So I think in 2026, we're highly likely to see a point there, probably soon, where the miners say, enough, I'm unfairly valued. and they're going to gush meaning a better place to be actually than gold. Now, when we go into the gold and silver miners themselves and look inside of it, we can see that silver miners are still very depressed relative to gold miners. In fact, GDX right now, which is supposedly the gold miners ETF, but it's actually got some silver miners in it, but mostly gold miners. It's above its price level in 2011. It blew out above that old high, okay, finally. It did it in a gush. Silver miners, SIL ETF, is only back up to its 2011 price highs, either side of $90. That's where it's trading right now. So it's been sold into in the last several weeks, just short of the highs it saw in 2011. The spread relationship, relative performance with silver miners and gold miners looks like it's ready. In fact, is starting to break out relative to gold miners. So if I were to again shift that issue, should I own gold or miners? Yes, you should own more miners, I think. You emphasize that component of the monetary metals. But within the miners, I would focus on silver miners. So just like focusing on preferring silver to gold, I would prefer silver miners to gold miners. Just silver catching up to a reality. But by the way, we've run studies in MSA for our subscribers that show some prior examples. And these aren't normal, I'll admit that. But when a market has made a mistake and stayed confined too long, and I'm talking about being depressed now, copper went through such a situation. If you go back and look at long-term copper charts back in 1970, 1980 to 1990 into about late 2005. So multi-decade range, copper was in a range from roughly 50 cents to $1.50. Back and forth and back and forth. That was its old reality. In late 2005, it broke out of that price reality. In a matter of a couple quarters, quadrupled in price, up to $4.50 an ounce, per pound. And lived in a new range after that. Oh yeah, it had some sell-offs after that explosion, but literally in the several quarters, it quadrupled. It didn't incrementally go up to a new reality, it exploded. Lead, a very dynamic market, was in a similar range-bound reality from those same years. And in 2007, a year and a half after what copper did, it also broke out of this multi-decade, very depressed range and went up, quadrupled in price in a couple quarters and lived in the new reality after that. Why has silver still been confined in that old reality that goes back into the 1970s? What is it, dirt? Or has it been contained by various measures? And that we're not going to get into that issue except to say lead did it, copper did it, gold's done it. Why is silver contained in a 50-year range? When it breaks out, you think it's only going to go up the same arithmetic range, or is it going to do like a quadrupling like copper did or lead did? Or look where gold is now versus its 1980 high. It's $4,500 gold versus 850 high. Where's silver compared to its 1980 high? It was $50 then. It's 80 now. It's trivial compared to what the ratio scale move of those other markets have been ongoing. I think silver's going to catch up, and it's going to a new reality.
Markets don't adjust smoothly when long-term suppression finally breaks. They reprice violently. History is full of stark examples. Copper spent decades locked in a narrow range, only quadruple within a few short quarters. Lead traced a similar path. Even gold eventually escaped its post-1980 ceiling, and once it did, it never looked back. Silver, however, remains trapped inside a pricing structure established more than half a century ago. That fact alone should raise serious questions. When markets finally shed outdated realities, they don't inch higher, they leap. Silver's prolonged confinement only increases the odds that its eventual breakout will be chaotic, fast, and far beyond conventional expectations.
And we know there's fundamentals behind it. The supply-demand situation for silver, industrial demand and supply, has been deficient for 5 years plus now, where there's just not enough supply to match the increasing industrial demand. High-tech industrial demand, solar panel creation. All these things are consuming a lot more silver than we produce. And despite the higher price, supply is not increasing, primarily because silver really doesn't come from silver miners. It comes from base metal miners. And so that silver price is not an incentive so much for them as it is the price of the underlying base metal that they're out to get. Anyway, those dynamics are now in play, and I think they're going to rapidly go to the new reality and probably even overshoot a rational new reality. And then there's also the other macro fundamental underlying silver. It is money. Don't forget that. And as gold rises, the monetary metal, silver is also monetary metal. Don't forget it, going back thousands of years. And as we get into government debt crisis problems, which we're on the cusp of now entering, our assessment, hence weakness in the stock market, it will follow that. Not necessarily dramatically in the first 6 months of this year, but probably later in 2026, we'll see some sharp stock market decline. Right now, frankly, I think the stock market is probably going to incrementally hold itself together and maybe even rally for another month or two. And any sharp decline, which I know a lot of silver and gold owners are fearful of because they think there's a correlation, and there's not. It's not a good correlation that if the stock market drops sharply, so must gold, for example. But even that type of event, I don't think is going to happen until we get mid-year this coming year. And goodness knows where silver and gold might be at that point, especially given our analysis that in the next 6 months, we should have extreme drama. So again, there's not just the industrial demand, supply-demand problem for silver. It's the monetary underlying crisis that is out there and is not going to go away this time.
Silver's story isn't merely technical. It's fundamentally compelling. Industrial demand has surged, driven by solar energy, electrification, electronics, and advanced manufacturing, while supply growth has stalled. Most silver is produced as a byproduct of base metal mining, which means higher silver prices alone don't automatically lead to higher output. This structural imbalance has persisted for years, quietly drawing down inventories. Layered on top of this is silver's often overlooked monetary identity, deeply rooted in history. As confidence in fiat systems erodes under mounting debt burdens, silver is uniquely positioned at the crossroads of industrial necessity and monetary refuge.
Our assessment is they're making topping patterns, not evident on price charts. But if you go back and do your history, you'll notice that, for example, in 2000, dot-com top, which led to a 50% collapse by 2002 in the S&P and an 82% collapse in the leading sector, the NASDAQ 100, which was the leader at dot-com stocks, internet stocks back then. That topping process took a full year. In fact, MSA issued a major be gone signal in January of 2000, and it labored both sides of that price level for a year. Higher than that level in price and lower than that level, but basically boring but steady, including a new high in the summer of 2000 that was higher than where we said get out in January by about 10 or so percent. But it didn't go down until you got really basically after the first quarter of 2001, it really started to come apart. So in other words, you had a laborious top, and yet it was topping by our momentum metrics. It said it's over, price may linger, but as far as an investment perspective, this guy's topping. 2007, same scenario. It was in December of 2006 that we put out a report projecting for the next year that the S&P then was like 1,400 at the close of 2006. We said next year, expect the high to be, we have target top range between 1,550 and 1,600, meaning a substantial further gain from 1,400 up to 1,550. And it got up to 1,550 plus in the spring, I think, of 2007, and had a collapse into the summer. It hit our numbers, got barely into our target zone. It got up to 1,555, I think. So 5 points into our target range and dropped hard. And then it came back up in August and September. And in mid-September, it was approaching the old highs again, meaning the 1,550 level.
Zooming out, the broader financial landscape is showing its age. Major equity markets are displaying the hallmarks of prolonged topping processes, the same patterns that preceded past historic declines. These tops rarely arrive with sudden crashes. Instead, they drag on, grind higher, and slowly bleed momentum until exhaustion sets in. At the same time, government debt levels across key economies are nearing stress thresholds. When instability finally surfaces, central banks respond in familiar fashion: liquidity injections, rate cuts, and balance sheet expansion. History is clear. These tools do not rescue equity markets, but they do debase currencies. That excess liquidity inevitably flows somewhere, and time and again it finds its way into monetary metals. In such an environment, silver and silver miners may not merely rise in price. They may be fundamentally revalued.
And the Fed cut rates. It was a surprise rate cut, 0.5 point. And it blew the S&P through that old high of 1555, which also had been the price high in 2000. Its peak then was like 1553. So call 1550 the high in 2000 and the early high in 2007. And with that Fed cut, they blew out those two highs. So if you're looking at a price chart, you say, oh boy, a triple top breakout. The Fed's going to cut rates. Everything's great. You should have shorted it right there. The high was 1573, I think it was, in October. And it dropped, didn't collapse. The collapse didn't really come till late summer of 2008, so almost a full year off the October 2007 high. But anyway, that was a laborious top also. It spanned a full year. What have we done? We made our high in January, February of this year, past year, and we're almost a year old. And we're about 10 or 15, we're about 15% above what had been the high in January, February, which is just below 6,200 on the S&P. Right now, we're in the mid 6,900s. So it's been further gain, but it's been really incremental. Once we took out that high back this summer, we crawled higher. We didn't explode. But I think we have an aging and maturing topping process in the U.S. stock market. And this is true with certain of these other bubble markets. Japan is also what we would call a bubble stock market. India is also one. China is definitely not a bubble market. Its price is only trading 1.5 times the price level that it traded at the 2009 bear low. So yes, it's higher, but it's not 10-fold or 20-fold that price like the S&P and the NASDAQ are. Europe is midterm bubble. It's not the same dimensions as the US compared to where it was in 2009. But we do have some bubble markets out there in terms of age, overpricing, and technical vulnerability. So I think it's going to be a global downside event, with the weaker ones being what are the stronger ones now. That'd be the US, probably India, and Japan. And we know that in the case of Japan and the US, we have a government debt crisis as well to add fuel to that implosion, which means what happens when that occurs? The central banks go berserk. They print money, they do QEs, they do whatever they can to save their bond markets and their stock markets. But that money doesn't work in that way. Yes, they create more money and it goes somewhere. It's always gone to gold, monetary metals. But it won't help the stock market because they cut rates from 2001 all the way down to 2002. The bear market continued in stocks. And they cut rates in late 2007 all the way down through 2009 and further, and the stock market still imploded. It doesn't help, but it does create money, which creates further fuel for the gold market.